Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. Really glad that you can join us. We are trying to help everybody, improve their retirement, whether they're already retired or looking forward to retirement. A lot of the things we talked about apply to both groups. We really do this through answering questions. And so you can send in your questions now. We can try to answer them live. You can send them in during the week so we can work on them. Send them to the email address here, asktom@talkmoneywithtom.com. Or you can put them right into the chat function here on the channel, and we'll try to capture those and answer those as we go. We always include questions that came up, in some of our client reviews too. So, things that we feel everybody should probably know, right? Mm-hmm. We created this channel as a resource. We really feel like there's a lack of education in the area of, how to handle your, retirement planning, your investments during retirement. And your tax planning in that time frame also. So go to the channel, you can subscribe, you can hit the bell button, get notified when we put new content on. And of course, you can just meet with us if you'd like to. If you have some questions, that you want to ask, you can go to our website, which is here on the channel. There's a link up in the corner of our website. A button looks just like this, a book appointment. You set up a 30-minute time to meet with Ethan and I. We can talk to you, on the phone, the video, in the office, whatever works. Just to kind of answer your questions, on a personal basis. So that's the beginning of our show today, and I always start off with a summary of what I saw happening in the stock market this week. I put out a video every day. This week I was actually on vacation Monday through Wednesday, but normally we have a video coming out and then we do a summary on Friday. So I'll start with that. Here's our chart. We've been looking at this chart for quite some time. This is going back to 2018. You can see the pandemic, the big run up after the pandemic, all these things. So if you look at what's going on here most recently, we've almost fully recovered. Actually, this is a weekly chart, and it looks like we have fully recovered on a weekly basis. But when you look at a daily chart, we actually had the 16th of July. We hit 56.67, I think. Mm-hmm. We're within 1% of that. And so that's what we're trying to do right now, basically, is trying to get to a new all-time high, to kind of solidify this recovery so we don't say, oh, we went up and then we came back down and kind of created this double top. And really, if you look at the charts, on a daily or hourly basis, you can see we just keep bouncing up against, within 1% of that all-time high and then kind of coming back down or what have you too. So, but this is a very strong recovery, just like the one we had in May from the downturn that happened in April. These are not completely normal. Last year was more normal, where we had that downturn and several, jumps up that were fake moves until we finally got to the bottom. We are having these V recoveries, which just shows the strength of the market right now. And there's a reason for it being strong. And we'll talk about that as we go here. But, of course, what we look at, primary direction, part of that is higher lows. Presented this last week. And, still trying to get through to that new all-time high, that line at the top there. So that's preserving that, primary direction to the up means continuing to stay above that last arrow there, basically, at this point in time. In this function, we look at other pieces also, the 50-day and the 200-day moving average and those types of things too. But this is an easy one for everybody to kind of see and understand. And so we have our, primary trends here. Just kind of looking at, the different portions of time for the S&P 500, the hourly chart, the daily, the weekly, the monthly. And you can see back in July 18th, the hourly actually went negative, and we ended up with a pretty good sized downturn. We were 8.5% down from our high. And then that on August 15th, almost exactly a month later, we came back to positive, and everything's green at the moment. There hasn't been a change since June 3rd on the market breadth indicators, where we're looking at some of the very big, broad ETFs and some of the more narrow ones that are in specific industries like semiconductors, utilities, and transportation, which are, if you're going to look at 8, these are not bad right here.
Yeah, and they're slow moving because we're using weekly data.
Yes, that's right. We're looking for more of a major trend change when we're looking at that portion of the data. It's not meant to be a indicator of downturn. Indicator. Yeah, it's really just sort of a, how bad is this? So yeah, the market's down like it was. It was down 8%. None of these turned, right? Mm-hmm. So it's just a kind of a confirmation for how bad, because what we look at for downturns, We'd rather the market just went up every day. It would make our job a lot easier, make everybody's job. Probably wouldn't have a job if it went up every day. so, but we don't worry that much about these smaller downturns. The 5, 10, percent downturns that happen. 10% downturn on average happens once a year. So, that type of thing. So what we're really worried about is that kind of 20, 30, 40, 50% downturns. And so that's what that market breadth is for, just to kind of show us, how bad things are getting. And, is it going across the board, or is it just certain segments or not? And so anyway, that's everything's good, right, as far as that goes. And today we had the core PCE, actually the PCE, both core and, headline inflation number came out. So basically, it always comes out essentially the last day of the month for the month prior.
Yeah.
So it's very late. We get CPI first, immediately followed by PPI, which is wholesale inflation. Both were decent, and then PCE though is the most important because this is what the Fed looks at, right? So a little hard to see this, but it's a 2.62%. That's essentially exactly the same that it's been for the last 3 months, 2.6%.
Yeah, it was another quite flat report.
Yeah, it'd be better if it was coming down, honestly. The Fed is trying to get that to 2%, but it's not coming up, and so that's sort of a neutral indicator for the market at this point in time.
Yeah, shelter's been kind of that sticky point for inflation. So I think it was up 0.4% month over month.
Month over month. So if you annualize that out, that's 4.8%, which is a lot higher than we're seeing in the other overall inflationary numbers. Yeah, that is the big driver. It's still rents, basically, being high and going up. That is still driving, the inflation numbers, which is kind of fascinating. There's lots of reasons that happens. But mainly it's usually a supply and demand thing where, there just aren't enough spaces for rent for the number of people that want to rent them. It's got so expensive to buy a home. I think that's one of the bigger drivers. And especially when you raise, mortgage rates from 3% to 6 or 7, makes it even more expensive to buy that home. And so more people looking towards rent as far as that goes. So anyway, this is a good number. There's two things that the market's looking at right now is inflation and recession. And we basically have good news this week on both. Inflation's doing well. I mean, it's definitely overall on that trend chart looks good. The last 3 years here, it's coming down. Got to keep coming down, so we watch that, but that's good news. And then the second thing that we got was the revised gross domestic product for the second quarter. So this is going back several years here, looking at 2023 and the first half of this year. We're doing pretty well.
Yeah.
I mean, those are good numbers, 2+%. First quarter of this year was at 1.4%. So, it's a little lower. We're a big economy. You can get smaller economies that can get big numbers. I remember China used to run in that kind of 7 to 9% for a long time. They're struggling to get there at this point, but they revised it from 2.8 to 3, which the market, I think, liked this week. We saw some good motion from that. But we're worried about recession and we're worried about inflation. Inflation's coming down. The gross domestic product is a kind of a one number, all encompassing concept of looking at how the economy's doing. We're not having a recession. Theoretically, not theoretically, but actually a recession is 2 negative GDP quarters in a row or more. And there's a board that decides that, and they've got other factors that they look at, and you don't find out that there was an official recession from that board until 6 to 12 months later, which is kind of weird. But the market is really looking at those two pieces. And the beginning of this month, we dropped 8.5% from our high, partly in July, but certainly here in August. And we ended up for the month in the end. But the downturn was at least partly some of the data that was coming out was a little bit weak. The job market was looking weaker. We got up to 4.3% unemployment, right? And so worried about recession, but I don't know. I don't see it happening here. We have so much momentum, and the stock market is an early indicator. It's a leading indicator. And if the stock market is showing strength, it's because it sees strength in the next 3 to 18 months in the economy, which means theoretically overall strength in earnings, right? And that's the key. That's the driver. I mean, if you want to pick out one thing that drives the market, it's very heavily correlated to earnings overall. And so this is another report that just came out today, just on personal consumption. Continues to just skyrocket. It's doing really, really well coming out of the pandemic. People are spending money, and even to the point where savings rates at 2.9%. That's not terrible, actually. Long term, we're right around there.
Yeah, we were in historic highs during the pandemic.
Yes, yeah, partly because there was a historically high amount of money being pushed out to the public too. So. And then, it was a little hard to spend money for a while. Of any substance, couldn't go out and do things. Even struggled to order things for a little while, especially goods and such too. So, the U.S. always has a relatively low savings rate. If you look at some of these other like smaller economies, emerging markets, you can see savings rates that are much higher. One of the reasons and the difference is that, in those markets, they don't have the same safety nets. And often they don't maybe have a Social Security type system. They don't have a Medicare, type system in place. And so people are saving more to take care of themselves, in that case of, retirement or emergency medical and such, where here we have the safety nets that allow people to, save less as far as that goes. So that's another good driver. It's, again, you look at that chart, we're not going to see a recession anytime soon with this type of, personal consumption growth. Even the disposable income is growing also. So what that means is that income is growing faster than the rate of inflation, which has really been a nice thing. It just gives more and more disposable income to go out and spend, and that stimulates the economy. And there's a lot of people very concerned about inflation and how much things have increased in cost, rightfully so. But what is happening on the back end of that is that we've seen a big increase in wages to offset that, and so things are. Unfortunately, it's not everybody, right? I mean,
No.
you could be sitting there with a fixed income and watching your grocery bill skyrocket, and you're not getting anything. But overall, as far as the country goes, we're seeing more income come in than we're seeing increase in price across the board. Now, your situation might be different, but the market looks at the whole thing.
Yep.
Yeah, and so that's why we're doing well. Now, all of this says to me that the Fed is unlikely to do a 2 rate cut, a half a point instead of a quarter point, right? And we've shared this chart before. This is a little hard to see. There's a lot of little data points on here, but this is a great tool. It's called the CME Fed Watch tool. This is where you can go to see kind of, what the bet is from the market.
So these are basically the future contracts on the rates.
Yeah, and so again, a little hard to see, but we're at 69.5% bet that there'll be a quarter point rate cut.
Yeah.
Right, and 0 bet that will stay the same.
Yeah.
So it's 100%. Now, this was also confirmed by the Jackson Hole speech that Chairman Powell gave here in August, who said they're looking to do a rate cut. So yeah, I mean, it's going to be one. Now the second column there, the smaller one, is for a half a point rate cut. Mm-hmm. That's currently at 30.5%. That was at 36% a week ago.
Yeah, but if you were thinking about a month ago, it was all the way down at 13%.
Yeah, and so it came up as we saw that weaker data come out,
yeah.
And now it's coming back down again. They revised the GDP, they showed us personal consumption pieces. The PCE index didn't go up. It's flat, and so I don't think we're going to see a half a point rate cut. And there's been a lot of articles about that, happening. I don't see it. They meet the September 18th. It's not that long from now. There won't be enough data points, I think, to change that. So I think they'll do a measured cut. There's also some political pressure. I've heard, several different Fed governors saying that politics never comes up in the room, so to speak, when they're deciding on different things. And one woman, what was her name? Lynn Baird, I think her name was. She's been in a couple hundred, and she'd never heard. So, however, there is pressure, to not affect the outcome of an election. Mm-hmm. So again, I think that also leads more towards a quarter point rate cut than a half. The next meeting is the 7th of November, and so that's after the election, so they can kind of do whatever they want at that point, at least from a political standpoint. But I do think we're going to see a quarter point rate cut here, so I think that's important. And just some quick data here, just on historical performance. We got the Dow, the S&P, and the Nasdaq here. Basically, from 71 to last year. How did the end of the year go? So from Labor Day, which is what, Monday, to the end of the year, the average performance, if you look across there, is what, 2.7 to 3.4%, right? That's pretty good. I'd take that as far as that goes. 72 to 68% of the time it's been up and higher. If you look at that, data across those pieces too, and I think that's spectacular. So, again, this is a time frame where the market can do fairly well throughout the rest of this year, combined with the strength of the market that we already have. And I don't know, this all flies in the face of article after article that I keep reading, talking about the big crash that's going to come or what have you. I've been reading that all the way through this upturn. I've been reading that my whole career, actually. Unfortunately, negative sells. It just does.
Yep.
I mean, if you want to start a newsletter and you want to get some subscribers or you want to get clicks on your website, you would talk about crashes, and because fear is a much more powerful emotion.
Yeah, but there has been a shift away from it, inflation now, but now
Right.
it's kind of shifting towards recession.
Yeah.
Is the new fear.
That's
in the
right.
articles.
It's all the same in a way. It's kind of funny because there are some people that are kind of famous for calling these tops. Peter Schiff is one, for example. So if you go look up Peter Schiff, he called the top in 2008, and he called the top in real estate. But if you go look at his, information, he's calling the top essentially on a daily basis. And so, you're bound to, what is a stuck clock is right twice a day, type of thing. And so you're bound to like get right. And so you get some fame for that. But when you really look at it, you're not doing anything, honestly. As a matter of fact, you're probably wildly underperforming if you're listening to that on all of the other days, for example. Now, this is the last thing here that I think is very fascinating. This just came out today in Market Watch. It's from Hubert Ratings, and it's just showing that and this is going back to 1896, and this is the Dow, right?
Yeah, it's a little bit hard to get data for election years. There's only so many election years.
Yeah. When you're doing data analysis, you want as many data points as you can get to a certain degree. I'm sure there's some limit to that. I'm not an expert at that, but the elections only happen every 4 years. And so, it's a bit more, I would say this data can be a bit more suspect just because there aren't as many data points. But at least this one does go back to 1896. And what they're showing is the average rate of return by month. So the kind of that bluish green bar is every year. And then, the orange bar is for presidential election years. And you can see it's actually quite different than the average. But if we look at August, that's the best month. We didn't have the best month so far. We're up about 1.6%. Not bad, considering we were down a bunch at the beginning and recovered so quickly to end up positive. I'm impressed. However, I think September is the most interesting one. So on average, you can tell September is the biggest down month, about 1.1% negative over this course of time on the Dow, right? S&P, I believe, going back, I think it was going back to 1970 for that data set we were looking at some time ago, was down 0.6%, also September. And then the S&P in that data set, the only month that was down was September. Now, there's a couple of others here. If you see February and April are historically down long term. But what it does show there is that September in an election year is slightly up. On average, which I think is really interesting. And of course, it just continues to ramp into October, and then November is huge. And it's less in December, mainly because I think it just runs so hard in November. It just doesn't have anything left to kind of keep going, but all positive. So it kind of fits in with the narrative that we just looked at. After Labor Day, market is positive on average. If you look at the average, election year cycle, September, October, November, December, all positive.
Yep.
Right. And some of them fairly high. I think that's about 2.4%, give or take, 2.3% in November, which is great. So you really want to hang in there throughout this time frame. We're not a big believer kind of, moving in and out, but there is a seasonal aspect to the next month. However, some of that could be offset by the election itself, and obviously by the rate cut that's probably going to happen on September 18th. So anyway, really fascinating time frame to be an investor, and I think that there's some really some good things to look at here, and continue. Now, we have made some changes even today to our portfolio. We have moved out of our utility positions. We have this, basically big list of we're looking for momentum, and utilities are still doing fairly well, but not as well as some of the other areas. And the areas that we are into right now are healthcare, real estate. There's a minimum volatility ETF, USMV, that iShares puts out. And it's kind of interesting. It basically just looks for stocks that have less volatility and puts them into one big basket. And technology would be the other, component across our, universe of models that we deal with. And that's working out pretty well. But it is interesting to me, because we basically just follow this momentum, that there is a fair amount of momentum in things that are not tech, right? We were heavily tech when things were highly moving in tech, even at the beginning of this year. And we're starting to see more momentum coming out of some other areas, lower volatility. People are a little worried about what might happen. Real estate, healthcare, these are, I wouldn't call them completely defensive categories, because utilities are also, but they are not tech, right? And so I think that's an interesting shift that's happening right now. I don't know if that'll continue. We'll see what goes on. People are kind of gearing up for, possible issues that might happen in September or whatever, right? And I mean, one of the things that you might do, and theoretically, you still want to stay in the market, right? You don't want to get out of the market. Primary trends up. And so sometimes what you can do is you can rotate and ratchet back the volatility of your portfolio. So you got utilities and real estate and healthcare, those types of things that don't move as fast, right? And so if the volatility actually turns to be up, you're still in. You're still going to make something. You may not make as much as some of the high flying stuff in an upward motion market, maybe small caps or tech or whatever it might be. But we are seeing a rotation in the market into less volatile non-tech areas. That's for sure. Well, we'll see if that continues, but it's something to be aware of. Matter of fact, that rotation has been violent enough, in my opinion, and even short enough, like the small cap run we had. And then, I mean, even this week we had a day where the market was down and small caps were up. And, so I would own everything. And that's our advocation, is that you should have probably about 3/4 of your portfolio in the broad market pieces, that it incorporates pretty much all of the stocks or all of the different types of stocks, market cap. In this environment, that's a really good place to be, because the money is just kind of rotating around. It's trying to find a footing, in my opinion. We had a very strong tech trend, has now changed into a decent tech trend, combined with a lot of other things moving around. And I think it's trying to find its way. And if the market's going to do that, just hold on to the whole thing for the most part. So anyway, that's our summary for the week. Thank everybody for joining us for that. I look forward to doing this again next week. But let's start off with some of our questions.
So why is the market having such trouble breaking through that previous high? And is this a good thing or a bad thing to kind of be close to the high, but kind of, going sideways?
Yeah. So let's just talk about support and resistance quickly. So resistance, which is what we're dealing with here, is a higher price than where you're at right now. And you get up there and you keep bumping it and falling and bumping and falling. What happened is that at that higher price, there was a lot of shares purchased. And so what happened in the short term, if you're below that, is whoever bought up there lost money. And so the theory is that when it comes back, they say, I'm going to take my money back. I made my money back. I'm going to move off. And so it starts to hit that, price point over and over. So the high on a daily close basis for the S&P 500 is 56.67. And we're within 1% of that and have been. And so what's been happening is we're kind of getting in that 1% zone and coming back down and getting in at 1% and coming back down. And we haven't been able to get through it. I don't know, what is it, about 7 or 8 trading days, I think. So there's pros and cons to this. It's not unusual what's happening right here, assuming we break through, because this is actually a kind of a normal pattern. Every time you get up there, somebody's selling and driving it back down, right? And so you're drying up that selling pressure, and then eventually the market jumps through. And obviously, if it doesn't, then you end up with this semi-double top, right? Now, the thing about a double top, at least in my experience, is that you don't normally have one that's straight up and kind of a peak, and then the other one's kind of sideways for a week or two.
Yeah,
and
it doesn't plateau for a little bit.
Yeah, you don't normally see that. You see 2 peaks, right? It gets up there and boom, it falls back down. And there's pretty good examples of those. Those would be considered a bad chart pattern, right? And so in a normal scenario like this, we'll go sideways for a while, we'll churn and break down all of that selling pressure and then break out to a new high. I would suspect that's what's happening. Inflation is tame-ish. Recession is not happening in my opinion.
Rate cuts are expected.
Rate cuts are expected. There's too many things happening here. We are heading towards a weak season. That's why we're not flying off the handle here. On the upside, but. So the other part, of course, is once you do break through,
it becomes support, and it's really good when you have a lot of buying a certain support level, because people feel confident in that area.
Yeah. So, 16th of July, you hit a high, and then you spend a week or two kind of right around that high again as you try to get back through, and then you get to a new high. And now what happened is you have a whole bunch of shares purchased at the similar price, and it's just the opposite of resistance. So the price goes through that. And maybe it comes back down, and people will say kind of the opposite thing they said was resistance. Oh, I bought, I made money. If it gets back to that, I want to buy again. I want to buy on the dip. And so it becomes support. And so the longer it goes sideways, the better the support.
Yeah,
it just means more and more shares purchased at the same price.
Basically, more you bounce off of resistance, the support level there becomes much, much stronger.
Yeah, and we've actually had quite a few examples of some pretty good, even this year, where we were trying to break into new highs, and it took a while, and that's good support, and that'll keep that primary trend going for the most part, because you get back down, instead of establishing a new lower low, you hit that support area, and then it kind of goes back up, and you end up with a higher low, right? And that's what's been kind of happening. Just these higher lows continue to go. So I think this is a very normal pattern. And especially if we do break through to a new high. I would suspect it could be next week or something, if it does happen. There is some seasonal issues happening here, so we'll see. It could take even longer. And again, as long as we break through a new high, taking longer is actually better, in my opinion. Let's build some great support, get ready for November's run or whatever it might be, to kind of get us really going. And we won't look back at this price point again for some time. Now, big things can happen and change any pattern, any momentum. I always talk about, China invades Taiwan, or something like that happens, because, Taiwan makes 70% of the world's, semiconductor, especially the high-end ones that are really important as far as that goes. And so that would halt, any chart pattern. So there's always things that can happen that are out there. I call them the outside influences. If we look at all the basics and we look at kind of what's going on with the economy, we look at the growth of earnings, all the different things that we would normally look at, the Federal Reserve's, positioning and what they're looking at is always important too. The market's doing great. And so it should continue to break through this thing, in my opinion.
So what are analyst price targets, and how do they affect a stock?
All right, so Wall Street, they call it an analyst, is somebody who generally, in this particular case, we're talking about somebody following a single issue company, a single stock. And so let's say it's Apple. I think there's 100 and something analysts following Apple.
Yeah, each bank or brokerage firm has an analyst that's kind of assigned to a stock.
Yeah, they might be assigned to several, but their name is on that, and so they get to know everything about that company. And the crazy stuff. Actually, I've seen different articles where they talk about looking at, like, let's say a grocery store. They use satellite images of the parking lot to get to, ideas of, how much flow is going on. And, there is really big money in the market, and anything you can do to try to get an advantage in information, even illegal, unfortunately, because that happens too. But this would be legal to use the satellite imagery, but, is going to be employed. And so an analyst then would come up with usually an expectation for how much earnings are going to come from that company, and then off of that they'll use a price target. It is usually based off the earnings, some multiple times the earnings. So let's say, well, Apple sells for 25 times earnings. The earnings go up to this. I'm going to move my price target up to 25 times that, and that's my price target. And so it makes a difference, actually. You'll see on especially a short-term basis.
Yeah, any upgrade or downgrade from some like well-known analyst or well-known bank will have an effect. Direct effect on a stock.
Yeah, I mean, we don't use that. We don't do a lot of individual security stuff. I think it is interesting to see, like, for me, it's more the aggregate. Is the aggregate increasing price? Is the aggregate increasing, across the market the aggregate analysts increasing, expected earnings. Now, I will say the thing that's interesting to me about the analyst is that if you look at earnings specifically, I think the S&P 500 has about a 9 or 10 quarter streak going here where it has had 75% or more of the companies reporting on the S&P 500 beat the analyst expectations on earnings and even revenue for that matter. So that means 3/4 of the time they've been wrong, right? So 3/4 of the different, companies have been wrong. So they tend to be conservative, right? And maybe rightfully so. It's, not all of them, though. It is interesting. There's always somebody out there with some high-flying stuff that's happening.
Yeah.
And actually, they've been more accurate recently than the others. But that's, so that's how it works. Yes, it does have an effect on the stock one way or another. And we've seen some upgrades. We saw upgrades for NVIDIA, after the earnings report.
After the earnings report, many companies upgraded NVIDIA, even though that day, Wednesday, they were, or was it Wednesday? They reported Wednesday, but
Thursday.
Thursday was the upgrades, and then Thursday, even though they were down Thursday.
Yeah, it was went the opposite direction. Even though, so I mean, NVIDIA was down 6% on Thursday, but that's partly because the expectations were off the hook. Because NVIDIA did really well. I looked at that report pretty closely, and it looked great to me. I mean, they had 120%, earnings growth year over year. That's not the 480 some odd growth that they had a few quarters ago, but man, it's a big company growing really fast and doing phenomenal things as far as that goes.
Basically in a quarter, they're doing what they used to do in a year.
Yes, and the stock was up, I think, 160% for the year prior to the earnings release. So that's part of why it's down too. That's that stretching that rubber band. It just it's really out there as far as that goes. But it's up 1,000% in the last 5 years or something like that. It's been a really good growth story for a company that actually didn't do that well for a long time. It's here local. We've got clients that work there even so, and all of a sudden, wow. Yeah. The problem, just to finish that, is kind of interesting. The problem that companies like that will face, and it's happened with all of these big companies, is that the stock does so well, you all of a sudden mint a whole bunch of millionaires that are working for you, and the people that are really important to you are now 10, 20, 30 million.
Especially because you give stock to incentivize to stay.
That's right.
As kind of like a reward for being a good performer. And so these people have tons of money and they start to retire out or they kind of take, become part-time. There's less incentive for them to work.
Yeah, it becomes a brain drain. And it's, people matter in a company of this size.
Yeah, it happened with Intel. Intel was one example of that.
You could probably pick almost every company that's ever had this type of huge run that has a lot of stock options out there. So anyway, I find that kind of fascinating. It's a longer term issue, but it's something NVIDIA will face. And that's why these companies are so actively, aggressively recruiting. Google is very active and aggressive with their different perks and such, trying to make sure they can keep as many smart people on board as possible. Doesn't always work, but yeah. Okay, what's our next question?
So, what is return of capital?
Return of capital. Okay, so I put $10,000 into a stock. I sell it for $15,000. I have to pay taxes on the $5,000 of gain.
Yep.
Right? Let's assume this is in a taxable account and not an IRA, Roth, or something like that. The $10,000 that I purchased originally, I already paid taxes on that.
Yeah,
right?
And the government, the whole principle is not to double tax you.
Right, exactly. It doesn't always work perfectly, but there's a few examples here and there. But nonetheless, in this particular case, your return of capital is that $10,000 you get back. The profit on that trade would be the $5,000, that you made. Let's say you got back $8,000. You didn't get back all your capital.
Yeah.
You put in 10, you lost money by the time you sold it, and so that return of capital is still the $8,000, but now you get a write-off, the extra $2,000.
Yeah, and so this is a non-taxable event. It's so they're kind of like two different. You have a taxable event for your gains and losses, but then you have like your return of capital is a non-taxable.
Yep, that's good way to put it. Yeah. All right.
So can I donate stock to charity?
Oh, yes. Matter of fact, that works really quite well. Let's say you have a stock that you bought a long time ago, and it did quite well, and you got a pretty good gain in it, and maybe it's not doing that well now, right?
Yeah.
But it's really hard to deal with it because you got this big gain. So selling it is kind of hard and such too. And so let's say that you give money to charities, on a regular basis. Instead of giving them money, you could give them some of this stock.
Yeah.
And so if you paid, $10 a share for that stack and it's now worth $15 a share or whatever, they get those shares at $15 because they're a charity. They can then turn around and sell that to, fund the charity. And they're a nonprofit. They don't have to pay taxes on that $5 a share of growth that you had.
And so this is one way. So kind of how we look at it is, are you making these kind of donations on a regular basis? Can we find a way to be more efficient with our donation? And so appreciated stock is a good way to kind of capitalize to be more efficient.
Yeah. In an ideal scenario, that stock's not doing that well anymore, right?
Yeah,
because otherwise you could give up some future gains. If you would have given up Nvidia at some point in time, it's now made 1,000% or whatever. But even then you can still give away Nvidia. But ideally, it's a stock that you have a big gain in that's kind of slowed down. Yeah.
Yeah, you're looking for something to slow down, and so there's some limitations though. So you can only do your deduction can be only for 30% of your adjusted gross income for the year. So whatever it is, you can only do 30% of that. But the nice thing is the remaining is allowed to be carried forward for another 5 years.
Yeah, so if you have $100,000 worth of adjusted gross income, you can give away $30,000, right? But what if you did $70,000, you could write 30 off this year, 30 next year, and 10 the year after, as long as it's all within that 5-year window.
Yeah, and so when you're doing this, always consult with a tax professional just to double check and make sure everything is up to par. But it's a good way that you can kind of continue your donations, and also make sure that you kind of, since it's an itemized deduction, try and make sure that you usually itemize, because if you don't exceed your, the standard deduction, then it kind of just, it's a moot point.
Yeah, and then you're just basically diversifying out of some of that stock that you don't really want anymore. So that's but you're not getting the write-off because your standard deduction is so high, and that's happened for a lot of people. I don't know the percentages of it's dropped down dramatically when they changed the standard deduction to be where it is now. It's much higher than it used to be. The percentage of people that actually itemize dropped pretty dramatically. Which is kind of nice. Actually, it's easier to file a tax return without all the itemization, and the standard deduction being higher is a really nice thing. I don't know if does that sunset also in the 2025? Does the standard deduction?
Not sure.
I know the tax tables and the state tax piece are potentially sunsetting. That's not getting a lot of play in this election cycle. It's interesting because it's actually a really big deal. They changed the tax code in 2017. So it'll be interesting to see how that plays out. Corporate tax dropped quite a bit, and so do they readjust that? That corporate tax does not sunset. That would have to be passed through Congress to increase that tax or change it in any way, versus Congress has to actually act on these our personal tax tables, our personal estate tax tables, in order to keep them where they are or to change them. Otherwise, they're going to go back to where they were, which was worse than where they are now. Yeah. Right. So, I don't know if the standard deduction is part of that sunset. I've never actually even thought
we
about
could do that as a follow-up question for next week.
That's a good, interesting one. I'm just because it is a big deal. It's a pretty good savings, whether that changes or not. All right. What's the next question?
So, should I still be concerned about inflation coming back, or is kind of a recession taking precedence?
That's a good question, because it's been throughout the course of my career, I've been 38 years, right? It's just been recession. There's not really been any significant. I started in 87. Inflation was on its way down big time. From 81 is I think when it hit its high, or some 80, one of those two, and the Fed funds rate was at 19%. We're talking about 5 right now. So it was a really crazy time frame. Oil went from $4 to $40. It went up 10 times, which is insane. If that happened today, we'd have a lot of inflation. And so throughout my career, we've just been talking about recession. And it is an important point in the standpoint of you will see the market react more violently to recession information than it even has to the inflation information. I think because all of us money managers are indoctrinated into watching out for recessions, the 2000, 2008 type of downturns that we want to, not be involved in if we can. And so all of a sudden, of course, we have this inflation. And there's a lot of, it's a political commentary about who caused inflation, what caused it. But it was global, right? I mean, it's hard to imagine any one party or person or situation when you have, inflation here in the U.S. and Europe and the U.K., it was a global inflation thing. So more or less caused by the pandemic and more or less coming down as the pandemic has renormalized out of our lives. But the fear is the last time we had inflation, it reignited. So the Federal Reserve started to see a weakening at that time in the labor market and started to lower rates, right? That's what was happening here. We've gone from 3.4% unemployment to 4.3% unemployment. And the Federal Reserve has a dual mandate to, lower inflation to 2% roughly on the PCE core inflation index, and then also to keep what they call full employment, which is kind of in that 4 to 4.2% unemployment range or better, right? So that's exactly what's happening now. And so there's a lot of fear about, is this going to happen again? And this Federal Reserve, I think, has hung back from lowering rates. And they have talked several times. Matter of fact, Chairman Powell specifically said they don't want to be known as the Federal Reserve that did that big inflationary.
They want to repeat the mistakes.
Right. They don't want to be that group because that was pretty bad. However, oil went from $4 to $40 a barrel in that time frame. And so it'd be like, we're in the 70s right now, it'd be like going into the 700, level on oil. And so you're going to have some really big inflation. I don't see that happening, right, in this time frame. It would be dramatic. There's too much oil out there produced even by the U.S. We're a net exporter now. Everybody expected much higher oil cost after the Russian invasion of Ukraine. And we did jump up to 130 and then came back down. And Europe was going to have this terrible winter, and it really didn't happen. And I think because there's other countries producing enough oil, Russian oil is still getting out there one way or another.
Yeah, OPEC's still there.
Yeah, OPEC's still there. And then and there's so many alternatives now that they weren't here. We didn't have as wind and solar and hydrogen and all these other things that are going on now that don't help that. So I don't think inflation will be the big issue, but it is something that the market's looking at. But now we're looking way more at recession, and so that's in August. Between the 16th of July and I don't know, around the middle of August here, we had a 8.5% drop in the S&P 500. And most of that seemed to be related to a time frame where the data was coming out saying a recession might be more likely. Since then, we've had data that shows the opposite, and that's why we're in the middle. So to me, that's important. You get that bad data for recession, which helps with inflation because nobody's going to feel like there's inflation if there's a recession. And then you get enough good data on the recessionary time frame to say, oh, no recession, and not good enough in a combination to say, hey, we're going to have inflation. That is a soft landing.
Yeah, you want that Goldilocks kind of situation.
That's the one we've had, and nobody wants to, think that that's going to continue. As humans, we have a really hard time seeing that. We want to focus on that fear.
Our brain's made to look for problems. We don't. What do we have to be scared of?
Yeah, you're thinking about the tiger when you're when you're going through the jungle or whatever it might be, because that's your survival instinct. And a lot of times I think that's sort of gets in the way of the stock market. If you're constantly looking for the tiger, you're never going to have as much stock market exposure as you could if you were feeling more secure in the overall scenario. So that's one of the reasons why we do this show, is to try to point out the positive. And we don't get as many clicks because we don't talk about the scary stuff as much. But this show started on the 23rd, not the show, but my recording of the videos started on the 23rd of March in 2020. That was a Sunday, actually, the first video I put out. And it was just because the clients were so scared about finances. The market's dropping 35%, and you've got this physical fear, of this virus. And so I was just trying to point out what was good, because it was buried. Dude, I had to hunt for it myself. It was hard to find. And turned out that the stuff that was good turned out to be we had a skyrocketing market. The next day was the lowest point for 2020 by chance. I didn't know. I just wanted to say there are good things. You need to be a good investor. I think you need to have a balance. And so what we're trying to do with these shows and what I try to do with my videos is kind of create that other side. Let's talk about some of the positives, not in a Pollyanna measure. I do talk about, some of the things that are going on that aren't working very well, but mostly trying to just point out what's going on that's good. So anyway, all right, that's our show for today. I really appreciate everybody that watches the show. Please send in your questions. You can send them in to asktom@talkmoneywithtom.com. We'll be here next week also. Look forward to being able to try to answer those at that time. You can go to our website. We got almost 2,000 videos or something by now. And, subscribe, hit the bell button when we, put out new information, you'll get notified. And then obviously you can also, set up an appointment with Ethan and I on a one-on-one basis, and we'll be happy to, talk to you, 30 minutes on phone, video here in the office. So thank you everybody so much for coming. Really look forward to being able to see you again next week.